You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
What is a cyclical downturn? I'll tell you what it is. It's a sale. And if you think a company was a good speculative buy when it was white hot in July at $2, and it's now at $1.25, if nothing has changed, it's gone from being a good buy to a great buy.
Well, thank you for tuning back into Mining Stock Education. We're going to be speaking with frequent guest Rick Rule from Sprott US Holdings. He's the president and CEO, has over 4 decades investing in the resource sector. He doesn't really need an introduction, even as much of an introduction as I just gave. I'm Bill Powers. This is Mining Stock Education. Rick, thanks for joining me again. And we spoke a few interviews ago about Warren Buffett buying gold stocks. Well, it came out in his latest 13F filing that he sold, I believe, about 9 million shares, which is about 42% of his position in Barrick. And he also was unloading more bank stocks, which I believe last time you said was even more significant to you. Any commentary you can provide to us on the most recent filings from Berkshire Hathaway?
I can't comment much on the Barrick sale. The Barrick acquisition made sense to me at the time, not so much as a speculation on gold, which I still think that he believes is a pet rock, but rather simply that Barrick was cheap. In other words, the free cash flow generation, and in particular, the net present value of future cash flows relative to enterprise value was attractive. I think I said at the time, and I still believe, that the decision to buy it probably wasn't made by Buffett himself, but rather by one of the underlings. Well, for you and I, an investment of that magnitude would be important. For Mr. Buffett and for Berkshire Hathaway, a $500 million allocation is not even a punctuation, not even an afterthought. The bank stocks, I think, are much more interesting. Buffett has said himself lately that the whole equation of investing changes in a period of negative real interest rates. As an example, in his own business, in the insurance business, you run the insurance business for float. It's a sophisticated form of borrowing. You loan the client your risk capacity in return for premiums. And the premiums received prior to the claims paid constitutes a pool of capital that's neither debt nor equity. It's a wonderful thing, this float. Unless you have a period of negative interest rates. The idea that investing your float costs you money as opposed to making you money means that your float is valueless. Similarly, with regards to the banks, I think Mr. Buffett is looking at the negative real yields and looking at the fact that the lending spreads that exist are probably insufficient risk relative to the leverage nature of, first of all, the economy, and secondly, the banks. And the risk, too, that the interest rate rises. An interest rate rise would decimate the value of the bank's fixed term liabilities, particularly things like 30-year mortgages. And I think that Buffett sees the end of the cycle of perpetually lower interest rates, the things that make bonds a speculation, as example, rather than an investment. And he's beginning to take care to position his portfolio to take into account the end of the credit bull market and the end of the bond bull market. And he's done that, I think, intelligently by getting rid of franchises that are real yield and spread lending oriented, like the big commercial banks.
What about Kroger? Well, Kroger, I should say, when I saw that he added to that position, it made sense. Whether you're in a down economy or up economy, we all need to eat, especially with price inflation that we see. No matter what the government data sends us, I do the shopping, so I know what I'm paying, and prices are going up. That makes sense to me. But GM was another one that stood out, Rick. I'm here in Detroit, so I have a lot of friends that are engineers, and they have their anxiety financially is directly related to how successful GM is. He added to GM. And for those of us that are maybe a little more negative on the economy, that one surprised me. Any commentary here you could provide?
No, actually, I'm less, let me rephrase, I'm less willing in my declining years to comment on things where I don't feel that my knowledge is competitive. I honestly feel that my knowledge is quite competitive in extractive industries because I spent 45 years getting to know them. I've also been a financial services investor, including being part of the startup of several banks. And so I don't feel on strange ground commenting on banks. With regards to things like supermarkets, I do my best not to step in them. And I probably buy a car every 15 years. So I'm unable to intelligently comment on either of those.
Okay, well, I'm going to ask you a question of which you are an expert. Let's head over to Africa and mining. Endeavour Mining, the producer, bought SEMAFO, in this summer, and then recently they're going to acquire. They announced Teranga Gold for only about a 5% premium. What is your commentary here? Do you like the merger because it lowers G&A and makes the company bigger, or any other insights you can share?
Everybody needs to understand this is not investment advice, although I own Endeavour. I think this merger is individually and in terms of what it illustrates, spectacular. The Endeavour people have been just absolutely spectacular implementers. Their merger with SEMAFO was well conceived. The merger with Teranga is well conceived. Their largest shareholder, La Mancha, is a superb African investment group and extremely supportive. The merger is in every way, I think, a wonderful thing. There are, of course, people who were disappointed, people who were looking to see Teranga sold for cash. But I don't think that they understand, and synergy is an overused word, but I'll use it anyway, the synergy associated with this. I think this is a case where 5 + 1 can equal 7 as opposed to 6. I think for the reasons that you described, which is to say, reduction in general and administrative expense relative to assets under management. If you can save $60 or $70 million a year in reduced G&A, this is like a mine that never has to deplete, a small mine that never has to deplete. It never goes away. It's wonderful. The second thing is that the Lundins have proven over 30 years that merging these companies, getting larger entities, increases the market capitalization, increases the liquidity, and increases the price per share, thereby lowering your cost of capital. Mining is a competitive business. A lower cost of capital is a durable competitive advantage. Finally, the officers and directors of the company are allowed to make investment decisions over a much broader asset base and a much broader opportunity set. So as an example, a one asset company may be forced, as a consequence of the fact that the guys who run it still want to have jobs, to make investment decisions that are suboptimal. If you are Endeavour, SEMAFO, Teranga, La Mancha, you have a very broad opportunity set, and optimizing your capital allocation based on the best available outcomes out of, say, 10 or 11 possibilities gives you the chance over time to meaningfully improve your investment results. I'm very enthusiastic about it. I also need to say, I'm grudgingly enthusiastic about Africa. I don't consider most African companies to be examples of good governance, but then I don't think that most governments around the world are examples of good governance. And I'm incredibly impressed with the emergence of the African middle class and the generation of young, educated millennials, who I think will be much less inclined to put up with the foolishness that the big men in Africa have exhibited over the last 50 years. So I need to say I'm an intermediate and long-term Africa bull. So I like this merger from every angle.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com. Rick, tax loss selling, which seems like some of us were wondering if we were really going to get into it in the junior miners, but especially as gold has sold off. I've seen some charts and I bought some shares in the last week of some junior miners that really took a nosedive in the last 30 days. Any general thoughts you could share with us or advice for tax loss selling this year?
Yeah, I mean, we talked about this the last time in our last interview. The truth is that in addition to being an extraordinarily cyclical business, this is a very volatile business. it is possible to have cyclical declines in the indexes of between 10 and 15% in a secular bull market, and to have them at least annually. I mean, the market can fluctuate by 15% by the same ease with which you breathe. What we've been through in a historical context isn't even a hiccup, and it has people scared. That's an example of people who haven't worked hard enough on their portfolio and on their knowledge to have confidence in what it is that they're doing. What is a cyclical downturn? I'll tell you what it is. It's a sale. And if you think a company was a good speculative buy when it was white hot in July at $2, and it's now at $1.25, if nothing has changed, it's gone from being a good buy to a great buy. The idea that people, millions of people, aren't sophisticated enough to recognize this is probably, frankly, the author of most of my success over the last 30 years. So while on an individual level, I sort of mourn for people who haven't figured out that if they like an asset well, it's better to buy it cheap. From a personal basis, I'm absolutely delighted. Listen, this summer, the juniors, the stuff that most of your people are interested in, were way, way, way too hot. Companies that shouldn't have been able to raise capital at any price, under any means, raised $20 million or $25 million. The hold periods are coming off that stock. The market got awash in financings, and the people who were stupidly brave in the summer are going to become stupidly afraid, which means that we're going to wash through a lot of stock and prices are going to go lower. And mercifully, the good stuff is going to go down with the bad. The way you take advantage of this is investing enough in yourself that you can understand the difference between the good and the bad. And when the morons sell off the good, you do them a favor and take it off them.
So kind of you to do that. ESG. When I talk to a lot of European investors in the mining sector, ESG seems to be a theme that comes up more. In fact, I spoke to an analyst earlier this year, and he said that's the number one theme for him this year. What are your thoughts on ESG? And do you think that you and me as North American resource investors, that we don't think enough about this?
ESG is paramount for many institutional investors. We at Sprott begin many of our conversations with ESG because it's going to come up. We have also, importantly, been focused on many aspects of ESG for 7 or 8 years at Sprott. I think it's important to unpack ESG as E, that is to say environmental, S, which is to say social, and G, which is to say governance, and not lump it into one catch-all feel-good phrase. You know, it used to be called CSR, or corporate social responsibility, and I've given a couple of lectures which people can look up, saying that the right way to look at it is corporate social opportunity. The idea that the mining industry ought to be able to get away with what it got away with when I came into the industry, which is to say the export of all kinds of deleterious materials from the mine site, is wrong. But mining by its nature is fairly sustainable in that the footprint of mining relative to the economic activity that it generates is tiny. If you were, as an example, to compare mining with other forms of economic activity in the United States, like let's say golf courses, green monocultures in riparian habitats, the environmental impact of mining relative to golf courses is negligible, but golf courses are, of course, green, so people think they're pretty. So in the first instance, we need to unpack what ESG is and think about doing no actual as opposed to no psychological harm. The second thing that we need to understand, though, is that ESG is an opportunity. As an example, in the mining business, when I came into it, the whole mining business, at least the top end of it, looked like me. Big, white guys, often old white guys. The idea that 3% of humankind had enough talent and enough intellect to maximize the opportunities available in mining is stupid. Why wouldn't we involve, as an example, more women in the business? Why wouldn't we access 50% of humankind? I'm not talking about righting an old wrong. Somebody else can do that. I'm a speculator. I'm looking for optimized outcomes. And why, looking for optimized outcomes, would we obviate the contribution of half of humankind? Similarly, several people, but most notably Mark Bristow, has shown the advantage of indigenous employees in countries. The idea that you airlift every 3 weeks somebody from Perth to work in Cameroon, when there are lots of Cameroonians who want to be in Cameroon, have good education, and don't have the same employment opportunities available to them in their home market. I mean, Bristow points out that this is the height of stupidity. The median quality of the potential employee in West African countries is higher, given the lack of employment opportunities. And unlike the Australian or the Canadian, they want to live there. And we should be all over governance. Now, what I think are the governance issues may be different than what the big thinkers think about as governance issues. But I'd certainly like to see directors, as an example, be fairly large shareholders. I think that's part of governance. And I absolutely think that the parts of ESG that have to do with first doing no harm, but also employing the company to the greatest range of opportunity sets is important. The other thing that ends up, and we've seen this within Sprott being important about ESG that people don't think about, is employees of companies want to be involved in something bigger than themselves. They don't just want a paycheck to take care of their family. They want to believe that they are part of an organization that's a good organization. And employees that see themselves as part of an organization that is, in addition to making money and paying them, doing a good thing, are employees that are A, happier, and B, more loyal to the organization. One example would be earlier this year during the Australian bushfires. Sprott, because we've made a lot of money in Australia for the last 40 years and have a lot of Australian friends, made a matching grant that allowed employees to put money up for Australian relief efforts associated with the bushfires, which Sprott would match. And the outpouring of goodwill from the employees around that was truly gratifying. The importance of real ESG initiatives on employee morale can't be overstated.
Excellent. And soft commodities, Rick, before you go for 2021, are there any soft commodities that you could just bring to our awareness that you might be bullish on?
I'm not smart enough other than the whole sector. If you would have asked me a year ago, I would have said beans, but they've done it. The soybeans have been on fire. I think I've told you before on your show, Bill, that the only sector of developed real estate that I'm investing in now is high quality U.S. farmland in the upper Midwest, simply because all of the soft commodities, but especially in the U.S. with the trade wars, got oversold. And I'm not suggesting that they're going to turn around in 2020 or 2021 or 2022. I'm not smart enough to tell you that. But I am smart enough to tell you that in a world where there are more people every day and those people want to eat and they want to eat better than their parents did, that the idea that soft commodities had fallen 50% in real prices and more in nominal prices was unsustainable. I'm not at age 67 going to be a farmer. I'm not going to stretch fence. I'm not going to do any of that. I'm going to buy farmland and I'm going to lease it to somebody better than I. But that's certainly a bet on the recovery of soft commodity prices in the next 5 to 10 years.
And why the upper Midwest? Just because it was the proposed best value per acre?
Yeah, I'd say the lowest risk. Probably on an unrisked basis, Uruguay, Paraguay, and Argentina might be better risks. But those economies are still finding their own way in terms of governance and their willingness to give permission to foreign owners to take cash out of those markets. The U.S. upper Midwest has superb soils. It has the best infrastructure in the world. It has access to one of the best markets in the world, which is to say the United States. It has more technological and financial infrastructure available to it and a better farming population than anywhere else in the world. And importantly, it has the Mississippi River system, which allows the distribution of inputs, heavy inputs like fertilizer, and the export of product, which is to say grain, on water, which is the cheapest form of transportation for bulk commodities in the world. So for many, many, many reasons, the talent of the farmers and other reasons like that, I favor the U.S. upper Midwest. I also like the fact that the demographics of American agriculture are changing very rapidly. The smaller family farm, which is to say the 200, 300, 400 acre farm operated by somebody my age, is going the way of the dodo. The farming operations that exist today are 4,000 or 5,000 or 6,000 acres, with the farming family owning perhaps 600 or 800 acres and leasing the rest from people like me. So the whole turnover that's happening now with older farmers whose sons or daughters don't want to continue the family operation, selling, and then financial operators like myself leasing the land to families who are able to operate on a larger scale, employ more capital and more expertise in the business, means that the whole farming business itself is upgrading in terms of capitalization and sophistication very, very rapidly.
Yes. Rick, before you go, the offer to review my listeners' portfolio still stands?
Absolutely. I'll tell you, I think I've been able to teach a lot in this process, but I learned a lot too. The offer briefly is that I'd love to engage your listeners in discussion, and to incent them to do that, if your listeners will go to a website, Sprott USA, one word, SPROTTUSA.com/rankings. Enter your natural resource portfolio. Please, no pot stocks, no bank stocks, no supermarkets, just your resource portfolio. I'll rank those stocks 1 to 10, 1 being best, 10 being worst. I will also comment briefly on those names where I think that my comments might have some value. And I will include, if you use the word charts in the subject line, the 50-year Barron's Gold Mining Index, which is the best visual tool for examining the anatomy of gold bull markets I've ever seen, and also a 100-year commodity chart that talks about the relative valuations of commodities relative to other aspects of the economy going back over the last 100 years. Once again, SprottUSA.com/rankings.
And that link I will also put in the show notes so for ease of clicking. Rick, I know you're a busy man, but thanks for taking time out of your day to come on the show. Much appreciated.
It's always a pleasure. Thank you for the opportunity. I enjoy it.